So if I just give you a bit of background around my experience. So I've been in the banking industry for well over 20 years now. The last probably 15, 16 years have been in relationship banking. So I'm currently a relationship manager for Barclays. I'm based in Plymouth, so I cover Plymouth, West Devon, South East Cornwall, and quite a large patch of the South Hams as well. Primarily, I deal with businesses with a turnover between 1 and 18 million pounds. However, I've dealt with startup businesses in the past, and I guess also really what I wanted to just say today is probably what we do discuss is probably relevant for whatever size of business that you may well be involved in as well. So if I kind of go back to March 2020, seems like a really long time ago now. The banks were asked to support businesses through a variety of schemes. One of those being the Bounce Back scheme, which was probably the first scheme which was launched, which was a scheme to offer any business within the UK, as long as they have operations solely within the UK, access to a Bounce Back loan of up to £50,000, which would be wholly underwritten by the UK government. Now, at that stage, I think we were given 7 days to draw up a facility really that would work and would be as easy to access as possible. So unlike most of the facilities that we'd offered in the past, those Bounce Back loans had no credit searches, no real background checks completed to make sure those loans were affordable, which is primarily why we would lend money in the first place. Hopefully that we are going to get it back, because in my experience, sometimes lending to businesses is I guess whilst we do want our money back, the primary concern is that actually we don't lumber businesses with far too much debt that they can't afford to repay, and then cause them issues with trading difficulties. So probably from about April 2020 through to about June, July 2020 was an incredibly busy time for myself and many of my colleagues, not just at Barclays, but right across all of our competitors, trying to assist businesses that were trying to access both the Bounce Back loan scheme and also the coronavirus business interruption loan scheme. You may well know of that by its slightly shortened name of the Civils loan scheme. Those schemes were available for any business with a turnover from £1 up to 25 million. Way in excess of that was the larger coronavirus business interruption loan scheme. Now, those schemes are available for businesses, and you can access finance of up to 25% of your turnover in the UK, or it could be double what your annual wage bill was. Now, it was either the maximum figure dependent on whether your turnover was a certain amount or whether your staffing costs were of a certain amount. So that's kind of where we come to. But I guess most of the discussion today will be around, what sort of support is there and is available for business. But I think I was given about 5 minutes, so I'll probably hand over to John or Tim just to pick up from that and answer some questions later on today, if that's okay for you.
Yeah, that's great. Thank you, Gary. Really, I think what we'll do is we'll move on to John, and then I've already got a couple of questions in the chat and so on. So should we come back to the questions afterwards? Is that okay? So
we've got Q&A at the end, Helen.
Yes, so. Exactly. Yeah, I think we'll do it that way. I'm just going to go back to gallery. That's it. Thanks for that, Gary. I think. Yeah, if you've got any questions that you want to pose, you can either put them in the chat to everybody, or if you want to just do it privately to me in the chat, then I'm happy to read it out for you. But if you'd like to just speak to somebody direct, then please let me know that as well. Brilliant, thanks for that, Gary. So John, should we move on to you, and let's hear what you've got to say with regards to Thomas Westcott Accountants' view of things.
Yes, thank you. Just to give a very quick overview of who I am, what I do. So I'm the licensed insolvency practitioner and a partner here at Thomas Westcott, heading up the business recovery and insolvency department. Been in the game about nearly 20 years now. Certainly not done it all, but seen quite a lot going on. And throughout both the 2008 recession and, of course, the latest pandemic, which has turned the whole world upside down. Thomas Westcott itself is a top 50 firm. We've got 17 offices throughout the Southwest, and we currently employ around about 260 people. We're quite a rounded firm, and we're offering all aspects of accountancy, tax work, payroll, financial planning, corporate finance, and of course, insolvency. My work personally, a lot of it is Southwest based throughout Cornwall, Devon, Somerset, Dorset, although we are UK wide in what we do. We're working closely with a lot of the bankers, the solicitors and other accountants in the Southwest to help their clients when needed. And of course, in these times, that seems to be increasing. So we're offering services really from informal services and formal solutions. So we're looking at these time to pay arrangements. We're looking at whether or not businesses have considered the pay-as-you-grow options specifically for the bounce back loans. We're looking at whether we can offer full and final settlements, or whether we need a bit more sort of formal solution of restructuring or a rescue plan through company voluntary arrangements, administrations, or the terminal options through liquidation. And in some cases where people want to start another business again, how to get out of their old business and start in a new business where they can. So from the insolvency side, myself and various peers, I think we've all seen a material increase in the last 6 months, and this is reflected UK-wide. So in Q3 2021, which was the latest insolvency stats, it was a 43.5% increase compared to Q3 2020. We're waiting for the Q4 stats to be released. I'm not sure they've been released yet, but I would only imagine, based on my own personal experience, that those numbers are only going to increase and possibly more as 2022 goes on. Some of the reasons when we're looking at these clients, dealing with the businesses, we often ask the directors for their own reasoning, and not surprisingly, pandemic is usually close to the top of the list. Brexit, which a lot of us have forgotten about almost, is still right and still needs to be dealt with, and that has certainly had an impact. But the main reasons is looking at this starting to repay the bounce back loans for the majority of the businesses we are dealing with, which is predominantly the SME market. A lot of the key decisions during the pandemic were, as we say, kicked down the road. So there wasn't any creditor pressure in this time. There were moratoriums in place where creditors couldn't petition or pursue a lot of these businesses for any debt that arose within the pandemic time. So we have seen a lot of decisions being kicked down the road, and now businesses having to deal with those decisions. We saw obviously the government schemes tailoring off last summer, most notably the furlough scheme, with a lot of businesses not really picking up the trade as pre-pandemic levels has obviously caused issues there as well. Other issues as well, we got repayment of deferred debt. We had the likes of HMRC offering a lot of VAT deferrals, some landlords as well. And again, it is this sort of kick down the road culture where all of a sudden you've got a lot of repayments to meet, and it is causing the cash flow issues for the businesses. We're also seeing a lot of people saying about the supply chain issues. Again, during the pandemic and because of Brexit, this has caused a big problem. That coupled with the materials being, the cost for materials increasing, it's just adding to everything. As insolvency practitioners, we have been asked to look at, by the Insolvency Service, we have been asked to look at misuse of furlough scheme, misuse of bounce back loans as well. So we've got to look at, and we've got a statutory duty to investigate companies in insolvency cases We have a duty to look at when the bounce back loan was taken out, why it was taken out, did it meet the criteria, and really what was it used for, because it needed to be used at the time for the economic benefit of the business. And what we are seeing in some cases, it was used most notably for personal benefit for directors. And that's where directors may find themselves come unstuck, where you get a nice insolvency practitioner like myself asking for explanations and possibly repayments to put the company back into the position it was. My feeling, there's a lot more to come. The last 6 months has been busy. We've been trying to help restructure a lot of businesses, but there are a lot of what I'd call the terminal businesses out there. The trade hasn't returned and simply can't meet their debts as and when they fall due, and need to be dealt with through a formal insolvency process. So I think we've seen a bit of a flurry, but I think there's a lot to come. I think on that, I will pass over to Tim, if I may.
Thanks very much. So my name's Tim. We're StartPoint Finance. We're commercial finance brokers, and we help businesses across the Southwest access working capital from a variety of different sources. And accessing capital isn't easy, as anybody who's tried to do it in the last few years probably agree. Best way to think of us is we're like bank managers that aren't restricted on size of business, and we don't represent one single bank. So in the last 2 years, we've organised different working capital solutions with over 40 different lenders, which gives an indication of the complexity in trying to source the right solution for the business. We actually get paid by the lenders. There's no cost to the client looking at those solutions. We're involved quite a lot with the Sybil's part of the government recovery scheme, and we're now doing quite a lot of the government replacement, which is the recovery loan scheme, which we're accessing through about half a dozen different alternative lenders. So in terms of cash, that's the main way of accessing funds currently. If not, you're looking at different security. So you're looking at invoice finance or hard assets that are then being refinanced. And the only thing that I would say is that the quicker, if you recognize that there's going to be a cash gap coming down the line, the quicker you look at it, the more likely you're going to get a solution, and indeed the lower cost the solution will be. So we deal with clients. We get called in when either they're growing very quickly or they have a combination of events that drain cash out of the business. And sadly, some people come to us not too late, but we may well get a solution, but the solution may well be more expensive than if they'd have tried to access it further. Most of our stuff comes from accountants or consultants, and we're roughly the last 2 years split between half of is repeat work for clients that need more working capital, and half of it is inquiries from third-party professionals. And we'll talk with anybody and look at a solution. As I said, there's no cost for finding an option. And we are quite successful at doing so. I don't think I've got anything more to add, but I'll gladly join in any of the answer any of the questions.
Thanks, Tim, and also thanks John as well. I'm going to go back to gallery view so that you've not got me on full screen. There we go. And take some questions now. Really appreciate all of that information that you've given us. I mean, there's quite a bit of background there to what you do, who you are as well. I think what we're looking for is perhaps some answers to some issues that are plaguing some of our businesses at the moment. Does anybody want to speak directly and ask a question directly. I've got to say several I've come through in the chat privately to me. So anybody want to ask something directly first? No? Okie doke then. So I'm sure these are quite general questions that everybody's really wanting to know the answers to. Maybe this is to Gary, but probably Tim and John will have something to say as well. What should I do if I'm expecting a downturn in trade? And what support can a bank or my finance providers assist me with?
Yeah, so I guess it really depends, Helen, on which or if any finance facilities that you're using at present. I think one thing I didn't mention in my introduction was around the pay-as-you-grow options, which John touched on in his opening remarks. So under the bounce back scheme, every business has the option to utilise what they call, what the government have described as pay-as-you-grow functions. Now, each business that has a bounce back loan has options to these pay-as-you-grow facilities, and they come in three forms. The first form is that you can extend the term of your bounce back loan from the original 6 years out to 10 years. But in effect, what you are extending there is the repayment profile of your facility. The difference you've got with bounce back loans against historic, I know probably Tim would agree with me here, your standard normal finance facilities, is the bounce back loans are calculated on a straight line basis. So your repayments are divided by the remaining months of the term that you've got left on your facility, and on top of that, your interest is added on top of that as well. So what typically happens with bounce back loans is your repayments each month will slightly reduce over the term. Now, obviously, by extending your term, you reduce your repayments fairly significantly. Unfortunately, with a bounce back loan, you can't just extend your term by a year or 2 years. You either keep it at where it is or it gets extended to that full 10-year term. The slight pitfall of course of extending your term is that because your loan is outstanding for a much longer period of time, there is an extra level of interest which you will have to pay because that funding is outstanding for a much longer period of time than what it was originally designed to do. The two other options that you've got under Pay As You Grow is you can have 1 6-month full repayment holiday of your facility. So certainly at the start of the bounce back loan facility, each borrower had a mandatory 12-month interest-free period. That interest was still charged by the banks, but was covered by the government, and that was under the business interruption payment system. Now, with that 6-month full repayment holiday, a business can take that full repayment holiday. Obviously, if you take that repayment holiday, all you're effectively going to do is make your long-term repayment slightly longer, and of course any interest over that 6-month period, which you do take that full capital repayment or full repayment holiday, I should say, will be added to the loan. So it will make your repayments in the long term much higher. But it could, in sort of John's scenario, if a business is struggling to get back up to pre-pandemic levels of trade, can help. The other option you do have with the Pay As You Grow, the third option, sorry, I should say, under the Pay As You Grow option is each business can take 2 6-month repayment holidays or capital repayment holidays, whereby you would still cover the interest during the period of your repayment holiday, but we just don't then charge the actual repayment proportion of your repayment each month. Again, the slight issue with that is you are then effectively reducing your term down, over which you would then repay the total outstanding debt. But those three options can help some businesses. Unfortunately, with the Pay As You Grow options, those are the only options open to all lenders. We don't have any other options to extend terms or to put other things in place. We are governed by the rules around these government supported loans. So pretty much what the government or the British Business Bank asks us to do, we have to put in place. What obviously won't find with the bounce back loan facility is any interest rate that you do have will not be altered during the term. You may have heard some stories in the past where banks have increased interest rates during any periods where there is some financial stress identified, and that will not happen with bounce back loans, and it's certainly not something that Barclays have done in my time, my last 9-10 years at Barclays as well. So some lenders might do that with traditional products, but that would certainly not happen on a bounce back loan facility. So
that's great, thank you very much. I'm sure that's answered quite a bit. So there are 3 options there. Tim, is there any other option that you could suggest?
So, well, the first thing I would say is it's really difficult to judge what is the new normal. So I think it'll take quite a while before we get a stable understanding of what's going to happen within businesses. But clearly there have been winners in as a result of COVID, but also sadly there have been losers. I would say you've got to act early. If you think you've got a cash flow issue coming towards you, you should take steps as early as possible, potentially in the structure of the business, so in terms of costs. If you've got, I'm talking about overhead now, so can you restructure the business so you can make a profit in the current environment you're in? If you've got, I mean, you're bound to have a bounce back loan or potentially a CBILS loan. So I would automatically extend it, because it's going to be the quickest and easiest way in probably the lowest cost debt to push that out and reduce your monthly costs. If you've got other debt, you really should engage with those lenders to try and come up with a pre-agreed plan as to how you're going to work your way out of it. And you sadly, because there are lots of different lenders, you will get different reactions. Most want to protect their capital, so they don't want to have a situation where you potentially fall into where John may be coming to a total conclusion and debt being crystallized. So I would recommend engaging. If you can plan a way out of it, and you do need more working capital, go back to what I said in my opening remarks, which is the quicker you identify how much and start looking at where you can source that from, the more chance you have getting it. So don't put your head in the sand, address it as early as possible, and you have the most chance of then trading yourself out of the situation that you're in. And you can access capital elsewhere. The better your projections, the better your management information, the more on top of your business you are, the more chance you've got of getting it.
Thanks for all that. Yeah, that all makes sense. And I think the main message there is speak to your lender, speak to somebody, find out what your options are. You know, everybody's going to be slightly different, and there'll be different answers, different responses from your lenders depending on who you are and what situation you're in. Oops, sorry, my phone just decided to ring. So yeah, don't forget to speak to somebody. And if you don't feel comfortable speaking to anybody, you know, you're a direct lender, I'm sure that either Gary, Tim or John will be very happy for you to contact them directly. John, is there anything you'd like to add to that about options?
Yeah, I mean, obviously, if downturn in trade and struggling with debt almost, you've kind of nailed it on the head. It is take advice early, whether that is from your accountant or from your bank manager, restructuring the debt. But if you speak to any insolvency practitioner, the message that we've been going on about for years and years and years is take advice early, because the earlier the advice is sought, the more options are available. Believe it or not, an insolvency practitioner's primary focus is trying to restructure or rescue the business. And those options decrease the longer the business is kind of bleeding out almost. And so if you do get there early, the more options can be considered. I think the other sort of questions I would be asking is there still an underlying trade? I mean, you could have a successful business previously, but post-pandemic, the trade may have fallen off a cliff. If you were dealing with certainly cross-border trade, and I've spoken to many businesses that dealt with other countries in Europe, and they're struggling because of the restrictions that are now in place, and the business just cannot get back on its feet, then you've got the answer to that question. I think Tim mentioned as well, can it return to some sort of profitability? That is key from our side when we're looking back as well, that if a company, if a director knew or ought to have known that the business couldn't return to profitability and couldn't avoid insolvent liquidation or administration, there then becomes additional potentially personal liability back on the directors, which is obviously worth highlighting. So best advice at the moment is, and I don't see this enough, but businesses need to get some basic short-term cash flow forecasts in place, and also document the decisions that are being taken and why you're taking them and what you're doing about it as you go along, not only for the benefit of looking forward, but also to mitigate the risk to the directors themselves if everything does go upside down in the coming months. So, yeah, I hope that helps.
Yeah, I think that message is coming through strong and clear about taking that advice early and looking at options, looking at alternatives, and getting that really good expert advice as soon as you possibly can do. Did you want to say something, Tim?
What I was reiterating what John was saying, really. It's nuts if you do actions knowing that you're in there that actually personally put you in a worse position, because it's getting worse and worse and worse. You want to think about what decisions you're going to make based on advice and proper knowledge, as opposed to what somebody tells you down the pub. Absolutely,
and it all ties in much more widely with what your business plans are for the future and strategy and so on. And in fact, on that note, I've got another message in the chat. It says, I'm considering opening a second venue as a separate limited company to my current sole trader setup. Are there any short-term, fairly small, perhaps around 10,000 funding options available to me, as it'll technically be a startup? Who would like to start us off on that?
There's a new business government loan scheme that you can access direct on the British Business Bank website. You'll find a link on our website as well. But so there is a government loan. It's quite difficult for a new start business to generate cash as a loan, because you've got no trading. You can point to the sister organisation, but it is a separate legal entity. So in my experience, it's quite difficult. And the government loan scheme is probably the best, lowest cost, easiest way of getting that sort of level of cash into the business.
Brilliant. Tim, are you able to put that link in the chat, please?
I'll ask somebody who can.
Or if you send
I was going to say on that as well, pretty much echoing what Tim has just said, but there are other government grants around still, and they are specifically aimed at new startup businesses. So there is help and support out there, and people like Tim can help with that, or we can point people in the right direction. And don't always think that a bank won't support. If there is, if you as a director of a new limited company are setting up in a very, very similar field, we can look at existing trading accounts for a business which is related in some format, if it's got similar decision makers or the same decision makers. If there is limited risk, and it would depend on what sector that you're operating in, there is still funding out there and available. And at those sorts of levels, you'd like to think that you've got a fairly good chance of securing what you require. But don't just necessarily think that borrowing the money is the only way forward. There are still grants out there, and also it would depend on where you are based in the Southwest. If you're based in Plymouth, you don't necessarily have access to some of the funding, or grant funding, sorry, which is available in Cornwall. So you could be based in Plymouth and not be able to access it. You could be based in Saltash or Tor Point, just across the river, and you can access some government support schemes and some government grant schemes as well. So there are those options as well.
Brilliant. Anything else you'd like to add to that, John?
Probably not, because it's
Not
probably
really.
more up Tim and Gary Street.
Other than I would say that talking to your accountant and making sure that you have a really solid business case before you go to a bank or potential lender.
Yeah, and certainly my general practice partners would be much more au fait with that. But yes, it's get your ducks in a row before you speak to your bank manager. Have your business plan, have your cash flow forecasts ready as well.
Great. Well, I hope that answers your question regarding alternative options for new business startups. The link, Sam, thank you very much for putting the link to the British Bank in the chat there, and hopefully you can access that. Like magic, Tim, eh? We've talked quite a bit about people who are struggling with cash flow and so on. Got a question here that actually refers to businesses that, and many of them are doing very, very well, about paying back the loan early. Is there a facility, is there an option to be able to pay back any of the government loans early? And if so, what's the cost?
I'll take that one on then. I'll take that
Thanks,
one
Gary.
on. Sorry, you're just going to get fed up of hearing my voice. It really depends on which scheme you've accessed, but typically, certainly the bounce back scheme, the Sybil scheme, those were provided on the basis that you could repay early and there was no early repayment charge. Now, you're not forced to repay the full facility, so you can repay proportions of that facility if you want to reduce that debt, but not kind of extinguish it completely. I've had a number of conversations with a number of my clients over the last, I would say, 5 or 6 months who've still got potentially bounce back or civil funds that they're set on deposit accounts. They were granted by their banks or the lender at the time because they felt they were going to be in some significant or under significant stress, I should say. That hasn't come to pass, and that they have kind of perform much better than they'd anticipated. If you think that you're likely to have some potential cash flow requirements in the future, what I would say is don't repay it if you think you're going to need it, because particularly around the bounce back and civil schemes, unless we find very, very significant and severe extra waves, those kinds of facilities are just not going to be available. I've been in banking for 20 years and never have I seen anything on the scale of the bounce back scheme and how generous the terms were of that. So what I would say is if you're kind of 50-50 as to whether or not it's the right thing to do, then don't repay it and keep it until you're absolutely sure that you will not require it. You will not get another chance to get 50k off a bank for 2.5% fixed for up to 10 years. It just won't happen, particularly on an unsecured basis as well. But yeah, really just to echo that, if you want to repay, there should be no early repayment charges. I would check the terms and conditions under who you borrow the money from, because there are some lenders out there that unfortunately did include some kind of early repayment fees. But I know certainly on any bounce back loan provider, we were not allowed to charge any early repayment fees. So you can repay that without any additional costs borne to you. Most high street banks and most kind of above board lenders would also not expect you to pay any kind of early repayment fee on those civils loans. But I have seen some documentation from other lenders who would insist that you pay an early repayment fee, but they're probably likely to be very, very few and far between, I would say.
Yeah, really good advice. Thanks, Gary. Yeah, I think you're right. I think while you've got cash is king, isn't it? So whilst you've got it, hang on to it while you can do. Yeah, great. And then another question I've got here, I suppose, again, Tim and Gary, probably aimed at you, maybe Tim more. is it too late to convert a loan to make it more manageable and affordable, sort of consolidate it with other finance? And I know that's something you've been doing. Is it too late to do that now?
So you could always reorganize. As Gary said, depending on who you're lending from will depend on what sort of settlement figure they want. So sadly, there are lenders where settlement doesn't, you can reorganize a loan, the settlement is too expensive for you to save much money. What we're seeing is not so much bounce back, but on the Sybil's loan size with a slightly larger advances, people moving into an RLS loan over a longer period to reduce the monthly payment. They may well have a higher interest cost over that 7-year period, but their monthly payment would be lower. And so for cash flow, that may still be a sensible thing to do. You could also convert into a different sort of debt product. So confidential invoice finance, for example, could be significantly lower interest rate than a RLS loan. So, and even a hard asset refinance. So if you're a business that's got a lot of hard assets, so trucks, vehicles, hard plant, you can use those as security and refinance over even up to a 7-year term at lower interest rates and pay off a more expensive bit of funding. And getting the options shouldn't cost you anything at all to make a decision. You go back to the original point, which is looking at your future debt requirements and addressing it as early as you possibly can. That makes sense.
No time like the present, I think. Yeah. Yeah, thanks for that. That's great. Yeah, I've got another question in the chat that's just come. What's the worst case scenario if the bounce back loan can't be repaid and the company has to liquidate? I think this is probably for you, John. How would that affect the directors on a personal basis, credit scores, personal liability, etc.?
I just take myself off mute. Yeah, well, as I said before, I think before we look at liquidation, we have to consider the other options available. And we start at the sort of informal options, the pay-as-you-grow options. But it is key. I mean, it's no good if the business is terminal to kick the can down the road further, else there may be more personal liability on the director for doing that. So it always, in every case, you need to explore all the options, from restructuring to rescuing the business to potentially selling it, trading it on. But if it is terminal, then the bounce back loans themselves are unsecured. The banks were not allowed to take personal guarantees from the directors, and where the bounce back loan was taken into a limited company, as I'm going to use as an example, then the director initially won't be liable to repay the bounce back loan. The banks have a duty to pursue the loan. They will then pursue the liquidator or through the liquidation for the loan. And I think they need to do that for the government to then actually pay the bank, because it's 100% guaranteed. Gary will probably confirm that they have to actually pursue the loan as well. But yeah, directors are afforded the protection because of the limited liability status of the company. A little bit of a caveat out there, as I mentioned earlier, when a company goes into a liquidation process, a liquidator has 3 months initially to submit a report to the insolvency service, and the insolvency service have asked us to look at these bounce back loans. So we have to look at the criteria at the time the loan was taken out. Was the company adversely impacted by the pandemic? It wasn't insolvent or in financial difficulty. I think it was December 2019. And ultimately that it was planning to continue to trade. As I said previously as well, it must be used for the economic benefit of the business. So where the directors have simply, and I've had a few of these cases, the £50,000 came in within a week, the £50,000 went out to the director personally. Now they are, unless the director's got a very good reason That's not looking very good. So ultimately, there's no personal liability unless the liquidator is looking and saying, right, what was the loan taken out correctly, or what has been done with that loan? Has it been used for the business, or has the director taken it out personally, or has the director started preferring creditors, typically himself or herself above others? But ultimately, if the answer to those questions are no, there's no personal liability with regards to the bounce back loans. There's other questions the liquidator's got to ask. Should the company have continued to trade? Now, wrongful trading was a big issue, but there was a moratorium again in place up until last summer. I believe it actually got pushed back forward. But again, if a company is continuing to trade and the directors are essentially knowing or ought to have known that that company can't avoid this insolvent liquidation, directors in that case, there is other personal liability that they could potentially be caught up for, where they should have made those decisions earlier. But I think in answer to the question, so I'll go around the houses a bit, in answer to the original question, for the bounce back loan, ultimately no, unless something untoward has happened to that bounce back loan, or it's been used incorrectly, or it's been applied for incorrectly. I don't know if Gary, just want to confirm my understanding of the bank's position there.
Yeah, that's kind of correct, John. I think one thing you just mentioned it at the end there is actually that the application was correct in the first place. We've started to see a number of applications over the last probably 9 or 12 months where directors or owners of businesses, because it's not just limited to directors of limited companies, who have applied for funding under the bounce back scheme where it didn't actually meet the criteria that you were stipulating on your application that you met. One of those that people are falling foul of is the turnover threshold. So, you know, if your turnover was less than 200,000, but you've taken a £50,000 bounce back loan, then technically you fraudulently accessed the bounce back loan scheme, and that may well then be where people like John and his colleagues within the insolvency industry may well report back to the British Business Bank that the loan was accessed incorrectly at that time. Yes, there is 100% guarantee from the government to the banks. That doesn't necessarily mean that the government will 100% pay us out. If we haven't done our due diligence on the application, and I say us, any lender under the bounce back scheme, if they hadn't done their due diligence correctly before lending, then unfortunately that guarantee may well be null and void. But we are obviously being asked as lenders, because unfortunately each lender that operated under the scheme is lending its money. The government did not give banks a big slug of money to go out and just, you know, lend these loans to businesses for the fun of it. We had to lend our own capital. Yes, there is a government guarantee, but it doesn't give us 100% guarantee that we will get it back. So there will be some moves to try and go back to directors or business owners to one, see what they use the facility for, and also if there is any chance of us getting some of our cash back before we would rely on reverting back to the government guarantee.
Well, I hope that, sorry,
I was just going to add on, obviously about the personal liability side, but there is the other side with the director's disqualification, because that the insolvency service can be very hot on that, as I say, misuse of the furlough scheme, or certainly misuse of the bounce back loan scheme, and they are maybe going to make examples of directors. So where directors have fallen foul again of meeting the criteria or abusing the bounce back loan and what it was used for, you could expect directors to be disqualified as a result of that, and disqualification would be somewhere between 2 and 15 years, depending on the severity of the abuse. Now, one that made the headlines a few months ago was a chap up in Birmingham. He literally set up 3 companies in summer 2020, get my dates right, took out £50,000 bounce back loan in each of the company, took it out personally and tried to get rid of the companies. I think he got about 12 or 13 years. Sorry, yeah, 12 or 13 years disqualification for that. And also the liquidator in that case will be pursuing him personally to repay those monies, because that is just plain fraud in that case. But it's just, again, another highlight that not only the personal liability for misusing the bounce back loans, but potentially director disqualification as well.
Yeah, you know, I think it's really important to highlight that. I'm pretty certain that nobody on this call at the moment, and hopefully none of our potential future viewers, will have fraudulently taken out a loan or misused it. But yeah, absolutely not on purpose anyway. I'm hopeful, but I'm absolutely sure there are people out there that will have done. And in fact, there was a question linked to what you were just talking about in the chat about the limited due diligence on some of the loans that were done, and some of the actual lenders weren't actually applying the full rules for due diligence. So I'm sure that, as Gary's referred to, the banks will be responsible for that, and not, or the lenders anyway, will be responsible for that taken by the government.
So there were lots of financial organisations approved under the scheme, and we know from direct experience there were real differing levels of due diligence and application of the rules. And what will happen to some of those lenders is they'll rely on a guarantee that won't be there, and because they had to push the funds out the door before necessarily they were audited, so they're audited in arrears in batches. There will be organisations that don't have lent and don't have the government guarantee, and that will have an impact down the line. But it's not the high street banks. It's some of the independents. But there were lots. There were lots. I mean, and to be fair, it's happening under the RLS scheme. You know, the RLS scheme should be applied by a lender in assessing a loan application. And if the RLS is the right way of moving forward to that advance, then it should be used. But there are independents that all they're doing is RLS. You know, so it is, with any set of rules, you're going to get different interpretation. But it's what you're then relying on as a result of those rules. In this case, it's the government guarantee. If it's not actually in place, it will be that institution that suffers. But as I said, it's not the high street.
Yeah,
no,
absolutely.
I think just going back to Tim's point on that, ultimately, I say no lender, but most lenders would not wish to rely on the government guarantee, because ultimately it's the UK taxpayer that has to foot the bill for this. So we will try and find any avenue, if we can, to not rely on that government guarantee, because there's everybody else out there that will ultimately have to pay for this. But going back to that due diligence point, I think Tim is right. Most of the high street lenders were trying to do what we could at that stage, you know, when most banks were probably, well, none of us knew about the bounce back scheme until it was announced by Rishi Sunak. I think it was that Thursday or Friday evening that, you know, banks would be able to offer this loan facility of up to £50,000. Normally, if I give you a bit of an indication, it would normally take a bank the size of Barclays about 9 months to develop a new lending product. We had 7 days. That gives you the sort of timescales and pressures that the banks were under to try and make sure that there was a facility there that was available for businesses in their time of need. You know, unfortunately, those high levels of due diligence that we would normally complete just were not always possible. So you will ultimately see some of those, like Tim says, where those guarantees just will not be paid out because the right rules and regulations were not followed. And unfortunately, like Tim says, unfortunately, there are a number of lenders out there that are just referring people on to the new RLS scheme as a default, so they have a backup. And that's typically a lot of peer-to-peer lenders who are lending not their own money, but their investors' money, but still want the government to back them if it goes wrong, which is, in my mind, not the right moral way to be lending money. But there we are.
Absolutely, thanks for all that. I mean, it's a complete minefield if you don't know what you're talking about, and I think it just goes back to our very initial point of find out some information, share with your respected lender, speak to Tim, John or Gary for some impartial advice, and I'm sure that they will be very happy to help you as members of the chamber. That's what it's all about. That's what we're all about here. And I do remember, Gary, you saying that. I remember when they came out, the loans, and the confusion that was around them. And, you know, we had so many members saying, oh, I've tried to apply for a loan and I can't get one, and the banks are, you know, being really tough and so on. But it was like the kickstart. So Rishi Sunak announced one day that this fantastic kickstart scheme was going to be launched. Nobody knew anything about it. DWP knew absolutely nothing about it, and that within 2 or 3 days they were expected to launch it, turn it around and so on. And it took 3 months for us to get any kind of processes and procedures in place and understanding of what the scheme was going to be and how it would work and so on. So I do very much feel for the banks with regards to those kickback loans, those civil loans rather, when they were forced upon you out of the blue. So yes, and we did lots of Chamber Live events over the last couple of years, really, on these exact same sort of topics. And it's now moving forward and we're catching up, and now it's sort of repayback time. So that's brilliant. I mean, that really brings us to almost to 2 o'clock, to the end of this session, which has gone really, really quickly. I do hope you've all found it useful. As I say, I know that Thomas Westcott, Barclays, Startpoint Finance, and us at the Chamber, we're all here to help you and support you to make sure that you can manage your finances and keep your businesses alive. I see Jeff Rogers is here from TS Partners, other accountants. You know, there are lots of really good, well-respected financial support businesses out there that we can signpost you to. So don't be afraid to ask. That's what we're here for. Unless anybody has anything else pressing that they really want to say, I'm going to say our final thank you to our speakers and hope that that's been really useful to you. As I say, we will be sharing this out on our YouTube and on our social media, so you will be able to sort of refer back to it if you need to. But in the meantime, if you need anything at all, just give me a shout. Happy to share some information wherever we can. Lovely. Well, it's been great to see you all. Thank you for your time, and we look forward to seeing you and hearing from you all again soon. I'm sure there'll be another similar session before too long.
Hi, everyone.
Yeah, bye-bye.